Financial Fitness. I'm Dillon Hakes. I'm joined today by John Roehrig. He's a realtor from San Diego, one of the top agents here in the county. John, why don't you tell us a little bit about yourself?
Great, thank you, Dillon. So firstly, been selling homes since 1989, since before computers, before fax machines. I'm a top agent, have been for as long as I've been in the county, which is 23 years here. And we specialize in people's best result in real estate. So I work with my wife, and together with our team, we work at a high level, and we have been for quite some time.
So the topic of this video is to give everybody a little bit of an update on what's going on with the Southern California housing market. I think people who pay attention closely, it's been a wild ride the last couple of years. Why don't you give us a 10,000 foot view? What's going on in housing? Where are we at today?
This is a really, really good question. And in fact, now is a better time than it has been in quite some time because things have changed so much and the dynamics are very different to even a year ago, right? So where do we begin? So firstly, my first answer to that is it's tricky, right? So why do I say it's tricky? Because there's many parts of the dynamics of our market that overlay, but they're unrelated, right? So for instance, hot topic is interest rates. You know, last year, this time, you were looking at low 3% interest rates. Today, 6.62 or so, right? So vastly different pricing, and that is real for the buyers that are getting financing in their pocketbooks.
Absolutely. How did that change in interest rates? We've talked to our clients about, and I think they're aware of what's gone on just in the last 12 months in interest rates. How did that affect home prices? What did we see last year with that move in mortgage rates?
So now what you've done is you've jumped from a pricing of money to a home pricing conversation, which is, it's really commonly done, but you can't do that because there's another component called supply and demand.
Sure.
Right. So you can talk about the impact of interest rates going up and how that is impacting the buyer's ability to afford more or less, but that may or may not and has not really translated over to pricing because of supply and demand. Does that make sense?
Yeah, absolutely. It sounds like you're saying that things really haven't slowed down that significantly.
Yeah, so they haven't, they won't. And now things in the financial markets may ebb and flow. You may be having roller coasters there, but until they can figure out how to actually create more land in San Diego, for the foreseeable future, we're going to have a shortage of housing.
So you mentioned the shortage. Obviously that flows to inventory and what's on the market. What do inventories look like?
They started recording inventories in 1982. This is the lowest since they started recording. Here we are.
I know this was a topic of conversation over the pandemic. People were talking about low inventories and that things had dropped. I think there was some hope that it would improve as we came out of it and interest rates normalized and started moving higher. Have you seen that, or we're still just at crazy low levels? Still
crazy low levels. And when you think it through, I have a chance to because I'm in this every day. The people who are selling are the people with the highest urgency. People who are selling on behalf of a trust or an estate, someone who's passed, people who are relocating and leaving the state, people who are downsizing, people who are empty nesters, right? They have a 5-bedroom home, the kids are gone, and they got to get rid of the stairs. We work with a lot of people like that. So outside of those three general categories, there's not a lot of movement beyond that.
How does that affect who is buying these homes? Is there a change in the composition of buyers? You would assume because interest rates have gone up, maybe potentially there's less people financing a home. Is it more cash offers? What are you guys seeing on the ground floor?
Right. So yes, a vast change in what's going on. And it's actually impacting things that may add to the confusion. And what I mean by that is if you're looking at what the media is saying, a lot of times they'll talk about median home pricing. That's very confusing in and of itself. So the median home price this time in January of 22 was $779. Median home price in 23, $924. So you look at it and you go, what the heck? What caused that? But you also can't actually make that mean the average price has gone up Average and median are two different conversations. Now, to your question, the reason why the median went up was because the amount of cash buyers was also at a all-time high last year, which was 40% of sales in the county were cash buyers. And by and large, those were at higher price points.
Okay, that's very interesting. What about the type of buyers that are either making cash or financed offers? Do you see a difference in, whether the person is a first-time home buyer or who these buyers are? Are they investors? Are those people still in the market? Has there any change to the demand on that side of things?
Well, let's talk about the three things you just said, cash buyers, investors, and first-time home buyers, right? So when the Fed hiked the rates up, definitely impacted the first-time home buyer interest, as obviously it should. At the median price, that means from the disparity between 3.5 and 6 something, that's $1,300 of payment variation with that with that massive adjustment, right? The homes became $1,300 more a month on average for a median price home in the county. So that massively impacted the financed offers, right? So for investors and flippers, when the rates changed a lot, they were all banking on the affordability for these first-time buyers to buy their product. And so we saw a lot of tightening and a lot of conservative views, like they pulled in, they weren't buying as much or they stopped completely. But by and large, they've actually reformatted how they're viewing things because they also see there's no inventory. So it's still a good time for them to be in that game and to provide a product for people.
Okay, so they haven't left the market is what you're saying. You're still
they're as strong as ever. They're just a little more conservative because they have to be. They've been trained that the low interest rates aren't going to stay forever, and they have to factor those numbers in when they're actually predicting and forecasting their businesses.
John, you mentioned that investors are getting creative with and getting more disciplined in their buying. How are other buyers who do finance the debt getting creative with the loans that they take out?
That's something that's really changed in the last year. It's had to, right? The buyers that are noticing that the inventory is light, it's going to stay light, they want to get in, and the pricing's gone up for the money. So initially what they did was they used adjustable rate mortgages, right? That's simple and obvious, right? So you get in at a lower rate and then you wait and bank on that the feds are going to lower their rates and then refinance. That all went away when the lenders saw that their returns were going away because people were using that as an avenue to actually get in. So those interest rates, the adjustable rates, are gone. They've priced them out of the market, so they're no longer something that buyers are using to leverage into the market. Now what they're doing is they're using buy downs that sellers are offering. So the buy down a rate for a year, you'll get it at a 1% discount or 2% discount. And that will hopefully bridge the gap between where the rates are now and where we hope the Fed brings the rates.
Are you seeing a difference in different segments of the market? Is there a difference in what you're seeing at the lower end here in San Diego and maybe at the higher end, or is it pretty uniform?
In terms of the temperature of the market?
Yeah, the temperature of the market, the demand, what you're seeing and what's changed recently.
Right. So again, I'm just going to repeat, it's tricky. So if you're asking me what zip code or area has the longest lines with offers, it's Carmel Valley, right? So you're going to see now, and that just changes. This is all situational, right? In January, for the first couple of weeks of the year, we were only seeing 8 offers on a property, as opposed to 22 offers, right? Now we're back up at the 22 offer range by and large in Carmel Valley. But when you talk about hot markets, that doesn't mean that a $5 million house in Rancho Santa Fe is not an equally hot market. Right. In other words, we'll see a house at $5 million hit on Friday and it'll be gone on Monday. Now, there weren't 22 cash offers. It only took 1. Maybe there were 3 or 4 offers, but they got the net result and got what they got sold. So just as hot, just a different response that needs to be managed. And I think that in and of itself is the reason why to actually work with an agent that understands, what's the yield going to be and how do I manage it? Because if you pick the wrong person to represent you and they're reading it wrong, it can go very poorly. It can cost you money and time and headache.
Absolutely. It is. It sounds like what you're saying is that, maybe some of these offers dropped off. There's a little bit of a cooling, but we've seen a reacceleration recently. Would that be fair to characterize it that way?
Absolutely. People still need houses. People are, it's a very sober view, but people are still aware that there's no inventory and we're not building enough houses. And so for the people who are lucky enough to have the resources to get into our market, they're doing it.
So we've talked about where we're at. It's still very tight. We have very low inventory. House prices are still very high, but the demand is still there. What are your thoughts about looking forward? Changing toward the forward view, what do you see for the rest of the year?
I don't see any change in terms of inventory, right? I see that the prices are going to stay stable. In some areas, they're going to accelerate, not at the rate they were accelerating, not that they should, right? That was not sustainable. I think that there are some areas of the market that are going to see some price adjustments, but it's going to be very mild. Now, generally speaking, you just look at what will drive value is location, right? So coastal, that's going to be more hedged. As you move east, it's going to be something that's more subject to changes in the market. But almost all markets are still very stable, and there's no real reason to be freaking out if you're a seller in our county.
So the last question I'll ask you, and we've talked to our clients about this, but we look at interest rates a lot on our end from a different view from you guys, but something you guys watch closely. What is your view on mortgage rates going forward? You mentioned that buyers are trying to buy down for a year in hopes that rates will drop next year or something like that. What's your personal view on it?
Well, I think that the crystal ball, what we're all watching, are the economic reports that will come out May 10th. Right? That's when we'll have 1 year where the Feds looked at the inflation numbers last year and said, we need to put a stop to this. And the predicted forecast is, I don't know if it's optimism or if it's real, that when the rates come out, or when that report comes out on May 10th, that those numbers will be favorable, and therefore the Fed will adjust the rates back downwards to some degree. So if you're a buyer, that may be the point in time to actually be paying attention to what's happening.
All right, John, so you think that May 10th might potentially be a pivot point for markets. Do you see interest rates going back to where they were, pre-pandemic, where we had these extremely low rates? What's your crystal ball say?
Well, it's a good question, right? I think the consumer has been trained to expect low money. Cheap money, interest rates that are probably not going to be feasible in the future. I don't think we're going to see them at as low as they got ever again. I think that they're going to go, there'll be some easing, but it's not going to you're not going to get 2.5% interest rates. I think that's, that ship has sailed. I could be wrong, but it's probably not going to take that low of pricing to get the Feds to actually accomplish what they're after to accomplish.
I think that's a lot of what we've been talking to clients about. I think our view is very similar to yours. So hopefully we get some easing, by next year, but I don't know that we're going back to the levels that we saw before.
It's unlikely. And, I've been doing this so long, I can, it just culturally people expect cheap money, and it's not the standard. Right. It's just not, 10% interest rate has by and large been the gold standard for being a good rate. And we've just been spoiled for a long time with money that was all but free.
John, what about empty nesters, retirees, people looking to downsize their house? Do you have any advice for those people?
Dillon, it's a really good question. And it's a really good time to ask that question, because it is a consistent portion of the market that is moving and happening at this time. So with, retirees, empty nesters, every situation's different. So what are they trying to accomplish? Are they trying to get to where they're in an active living kind of situation with people their age? Are they looking for a move where there's going to be more assistance? Are they looking to lose the stairs? What are the things they're trying to accomplish? And that is a big part of the cash market that's moving along, because they're selling their homes and then moving the cash over to these other residences. So we're very familiar with all of the choices within our market here, and we can actually work through what's important to people, but it's very individual because one person may be healthy, the other person may need assistance. So it does vary, but there are very solid choices and clear paths. It's just situational.
What other advice would you have for somebody? Is there anything for if somebody's looking to sell their house or enter the housing market in general, anything that you think they should look out for, or just general advice?
I'm really glad you asked me that. So I think the only thing that the consumer right now needs to be hesitant or looking out for are any approaches limiting exposure to your home if it's going for sale. So what we're seeing are more pocket listings, more let's keep it in-house and do a private sale. And look, it's supply and demand. The more people who see a property, the higher the price is going. So I'd be very leery of anyone who pitches, hey, let's keep it in our brokerage and not have the whole world know about it, because it will end up benefiting the brokerage and costing you as a seller. So I would really make sure that everyone really looks at that hard before making that choice.
I do think that's something that people should be looking out for. Thanks, John, for joining us at Financial Fitness. John, if clients have questions for you, how should they get in contact with you? Great.
You can reach out to me directly at 858-531-4119, or you can email me at John, John, at SanDiegoBrokerage.com. We have really good content. We do home evaluations. We do all kinds of things to stay in touch and be meaningful for people.
Thanks again for joining us.
Yeah, you're welcome.
Thank you guys for joining Financial Fitness. We'll see everybody next time.